spoke with a lender last fall when interest rates were at 3%. And now we're looking at 5.5 is where we're moving. So interest rates have doubled, which means, let's say you're looking at a $200,000 home, your price went up $150 a month. Not only did your price go up $150 a month, but houses have increased approximately 5 to 10%.
It's Nick with the Zealer Group, and I'm coming here today with a quick update on mortgages. And I actually have Amanda Feldman with Silverline Lending, who is our preferred lender. And there's a lot of change going on right now, especially for first-time home buyers. We've seen a lot of updates within the mortgage industry, and I thought there was no one better here to kind of discuss what's happening. So Amanda, you've been in the mortgage industry for how long?
16 years now.
16 years, and you originally actually started with Quicken Loans, right?
Yes, now Rocket Mortgage.
Rocket Mortgage.
I started with Quicken Loans in 2006.
Okay.
And it was a very fun ride. I remained a loan officer the whole time I was there and decided to leave in 2019 to give my clients more options by taking a position in the broker world.
Awesome. So you've been in 16 years.
Yes.
So in the span of 16 years, obviously you've seen a lot of changes. So you were coming in right almost when the recession was.
Right before, yeah.
Right before.
Yeah, so I got to take part in the lovely loans that caused the recession. No income, no assets, stated income, a lot of different programs, negative amortization that really don't exist in the market anymore today. So there's been a lot of changes. Unfortunately, Thanksgiving of 2008 was a very tough time. A lot of phone calls had to be made, and people in process unfortunately did not get to make it to the closing table because of the changes in the industry. So 2008 and 2020 were very similar in terms of a lot of program changes and a lot of clients that maybe started off thinking they were going to get to the closing table, not being able to make it there just with the changes in the industry due to the economy.
Right. And how different is the market today versus how it was even 5 years ago?
I can't believe that we're still experiencing the bidding wars like we've never seen before, and the limited inventory. But right now it's more important than ever to be qualified, taking the time to make sure that you've done all of your homework up front. Because when you're having to submit, multiple offers to finally get one accepted, nothing would be more upsetting to find out that you can't actually make it all the way through to the closing table and get the keys.
Well, and that's really what I wanted to kind of discuss was I think there's a lot of people entering the housing market right now. Obviously, the rental market has changed. It's becoming a lot different right now when you're entering the housing market. And one of the biggest questions we get is, what do I need before I just buy a house? So can you kind of talk about
money?
Okay. Money. That's a good start.
The number one thing I hear is people are maybe necessarily accounting for that 3.5% down that you see a lot of first-time home buyers taking advantage of the programs that are out there. But they forget about the other part, that just because you have only enough for your down payment, there's still going to be closing costs associated. You have property taxes, you have homeowners insurance. There's a lot of things that come into play when you're trying to close on a mortgage that people forget about.
Right.
So it's really important to make sure that you have that saved up, but also a lot of loan programs require reserves. So you need to have something left over. So I think that's the number one thing people miss out on, is not being prepared enough financially with their savings.
Perfect. Just to kind of recap what you're saying is you want to make sure you have a good reserves saved up. Obviously, a minimum of about 3.5% of what you're thinking about purchasing, correct?
Minimum is 3.5% for your down payment, but you also need to actually double that.
Double?
Yeah. Okay. So let's just use an easy number. Let's say your budget's $200,000. So just by having the $6,000 saved up for minimum on a conventional first-time home buyer program, that's not going to put you in a good position to get into that home. One, you have to think about the fact you have to give an earnest money deposit. You have to pay a home inspector. You have to pay for your appraisal. A lot of people don't realize this, but you have to pay your first year's homeowner's insurance premium in full. When you're only putting 3% down, you're required to have an escrow account. So you'll need to establish that with your property taxes and your homeowner's insurance. So not only are you paying for 1 year's homeowner's insurance premium, which roughly is $1,000, and then you have to put 3 months reserves of that, so that's $1,300, plus your property taxes, there's another $2,000. And then you're gonna have tax prorations. There's a lot that goes into buying a home. You have your title insurance, and granted, you can get seller's concessions, but as you and I both know, is this a market for seller's concessions?
And you can see Amanda's throwing out a lot of different terms, a lot of things in the real estate world, and some stuff a buyer may not know. So out of curiosity, if someone says they're going to buy a home this summer, when should they actually start having that conversation with the lender so they can understand everything to expect?
Now is the time to have that conversation. Even if you are not necessarily ready with all of the funds you have, I think it would make sense to speak with a qualified lender to say, here's where you need to be. So you have a benchmark, so you can set a goal for yourself. You don't, the number one mistake I see with first-time home buyers is like, oh, I don't have that money now, but I will. Okay, but so then you're not qualified to buy a home yet. Right, let's not count our chickens before the eggs, right?
Yeah, so basically, I don't want to go and say, I'm going to buy a house in June. We're going to buy a house this June, right? And what you're saying is don't call a lender when you decide you want to start looking, because there may be things you have to work out and you could end up falling into September, October, November.
Absolutely. Let's say you use Credit Karma, Nick. You love your Credit Karma and you think you're doing a great job and your credit score is where Credit Karma says it needs to be. You have a 640 with Credit Karma. I, the lender, pull your credit profile and get a financial credit report. Turns out you're at a 610. It's 30 points lower than Credit Karma. So as long as you're not waiting to the last minute, I can say, okay, Nick, I put you in touch with my credit repair team. We need to do X, Y, and Z so you're ready to make that step. And sometimes it's a really simple fix. It can be fixed in 30 days. There's no time like the present to at least make sure that you're making the right steps towards your goal.
And something to think about, and this is as of March 2022, we're obviously seeing a lot of inflation in the market and the Fed has decided to increase interest rates. Now, compared to where they were even 6 months ago, we've seen a lot of changes and hikes in the rates itself. I'm curious what your thoughts are, and if you could explain it to a buyer who maybe doesn't understand exactly what happens, what actually is going on when their interest rates get increased? How is that affecting their affordability in terms of purchasing power, also in their monthly payment?
That's a really good question. A lot of people don't realize that interest rates are a commodity, right? Like it's traded. So it's not, I'm not going to have a very different interest rate than someone else, right? It's all set by the market. And what's really important to know is that as interest rates go up, your purchasing power goes down. So maybe you spoke with a lender last fall when interest rates were at 3%. And now we're looking at 5.5 is where we're moving. So interest rates have doubled, which means, let's say you're looking at a $200,000 home, your price went up $150 a month. Not only did your price go up $150 a month, but houses have increased approximately 5 to 10% since you started looking in the fall. So you've also lost an extra $50 there. So you're out $200 in your budget. For some people, that can make or break their debt to income ratio. So it's very important that you keep that in mind with your budget and how the payment is going to impact it and your qualification.
Perfect. And are there any tips you could give to buyers that are thinking about purchasing a home in 2022?
Yes. Get approved first. Make sure you have all of your documents together. It's very important in order to have a smooth process that you're prepared and you're a good client as much as you want a great realtor and a great lender, someone that's going to take the time for you, show you the market, and make sure that they have your best interests in mind.
So Amanda, we've been working together for how long? About a year and a half so far?
Yes.
Roughly. And I've worked with a lot of different lenders in my career. I've been in the business 7 years up to date. And one of the questions I wanted to ask you was, sometimes lenders can actually make or break a deal. And we've been in plenty of situations where we actually had loans that were going to fall through, where we switched them over to you and you were actually able to get them closed. Can you talk a little bit about how a lender impacts an actual transaction?
Nick, that's a great question. I'm glad you asked. A lender definitely impacts how fast you get to the closing table and if you actually make it to the closing table. Being a broker gives me options. We work with 7 different lenders right now. So I'm going to have a good home for you regardless of your credit score and regardless of the type of program you need. For example, we have bank statement loans. If you're self-employed and can't necessarily do a traditional loan where we're using your tax returns to qualify you. We also have the ability, if we get a low appraised value with one lender, to simply pull your information. We use that same credit report. We already have all of your supporting documents and can easily switch you to a different lender, making it seamless so we don't miss that closing date. So there is a ton that goes into it, but the most important thing is when it comes down to choosing your lender, make sure it's someone that's experienced. An easy way to look at how much experience they have in the industry is going to be their NMLS number. Mine, for example, is 30760. It's only 6 digits long. I've had the same NMLS number since 2008 or 9 when it was implemented. So that's a good way to see how long is your loan officer been in the market. Do they actually know what's going on? Did they just start last week? And you'll get a lot of that when you're talking to maybe an online lender. where they just recently got their license and they're out and about. Also, something to keep in mind is a credit union or like someone at Chase Bank, they actually don't have to even be licensed to write loans. They do have to take a single class that's government regulated. So that's always something to keep in mind is like what options do they have available to you? Because if you start with a bigger lender, you could only work with that lender. They're not going to have the ability to move your loan on to somewhere else if it's going to be a better fit throughout the process.
All right, guys. So thanks for tuning in, checking out what's going on with the mortgage industry. We're going to drop Amanda Feldman's information below. If you have any questions about mortgages, you can reach her there. Thanks for tuning in and have a great one.